Hi everybody. In the previous videos, we talked about 3 events that could change the balance in the pension benefit obligation: the current year service cost and interest cost, as well as prior year service cost. In this video, we'll explore 2 additional events: gains and losses resulting from a revision of an estimate, and payments to retired employees. In the last slide we discussed in our previous video, we calculated the PBO balance of $183,099 at the end of 2021. This was calculated as the beginning balance plus the current year service cost of $15,258 plus interest cost of $9,500 to equal the PBO balance at the end of 2021, $183,099. That calculation is duplicated here on this slide. We mentioned earlier that a number of estimates are necessary to derive the PBO. When one or more of these estimates requires revision, the estimate of the PBO will also require revision. The resulting decrease or increase in the PBO balance is referred to as a gain or loss, respectively. Let's modify our illustration to imitate the effect of revising one of several possible estimates involved. Suppose, for instance, that new information at the end of 2021 about inflation and compensation trends suggests that the estimate of Faro's final salary should be increased by 5% to $420,000. So this revision has only one change: the revision of her last year's salary. Previously, it had been estimated at $400,000. Now the estimate is $420,000. Running the exact same calculations through, the required balance in the PBO is $9,155 higher than it had previously been estimated. Remember, the PBO represents a liability to the company. Accordingly, an increase in the balance of the liability will result in additional expenses. The additional expense here is called loss on PBO. So, as discussed just a few minutes ago, the PBO at the beginning of 2021 was $158,341, and we added the 2021 service cost, which has not changed. It's still $15,258, and we added the 2021 interest cost, which also has not changed. It's still $9,500, but now we add a loss on PBO that we just calculated of $9,155, which causes the PBO balance at the end of 2021 to be $192,254. The revised estimate of her final year of salary that we just calculated caused an increase to the PBO, so we recorded a loss. If a revised estimate caused the PBO to be lower than previously expected, a gain would be indicated. Now let's consider how a few other possible estimate changes could affect the PBO balance. A change in life expectancies might cause the retirement period to be estimated as, say, 21 years rather than 20 years. Calculation of the present value of the retirement annuity would use N equals 21 instead of N equals 20. the estimate of the PBO would increase. The expectation that retirement will occur perhaps 2 years earlier than previously thought would cause the retirement period to be estimated at 22 years rather than 20 years, and the service period to be estimated at 28 years rather than the 30 years we've been using. The new expectation would probably also cause the final salary estimate to change. The net effect on the PBO would depend on circumstances. A change in the assumed discount or interest rate would also affect the present value calculation. A lower rate would increase the estimate of the PBO. A higher rate would decrease the estimate of the PBO. Remember, what we've been doing here is calculating the present value of the amount that will be needed to provide pension benefits to employees when they retire. Another change in the PBO occurs when the obligation is reduced as actual benefits are paid to retired employees. The payment of such benefits is not applicable to our present illustration because we've limited the situation to calculations concerning one employee who is several years away from retirement. Remember, though, that in reality the actuary would make these calculations for an entire pool of employees covered by the pension plan. Illustration 17-8 in your textbook summarizes the 5 events we have been discussing that can result in a change in the balance of the pension benefit obligation. This is an important illustration, and I suggest that you flag the illustration for future reference. The obligation will increase each period for the current year service cost and the current year interest cost. Prior service cost will increase the obligation only if the plan is amended or initiated that period. Losses will increase the obligation and gains will decrease the obligation whenever revisions are made in the pension liability estimate. And obligations of the PBO will decrease when retiree benefits are actually paid. For our sole employee, the PBO at the end of 2021 is $192,254. Let's now say that Global Communications has 2,000 active employees covered by the pension plan and 100 retired employees receiving retirement benefits. This illustration expands the numbers to represent all covered employees. Assuming the balance of the PBO at the beginning of 2021 is $400 million, we add 2021 service costs, assumed to be $41 million in this example, and we add $24 million of interest cost for 2021, calculated by multiplying the beginning balance of $400 million times the 6% discount rate we've been using in this example. Add an assumed loss of $23 million in this example and subtract retiree benefits actually paid during 2021, assumed to be $38 million in this example. Now let's work a concept check problem. M. Howard, Inc. has a defined benefit pension plan. On December 31st, the end of the fiscal year, the company received the PBO report from the actuary. Among the information included in the report were the following items. Ending PBO was $110,000. Benefits paid to retirees during that year was $10,000. Interest costs for that year was $7,200, and the discount rate applied by the actuary was 8%. What is the beginning PBO? You might think you don't have enough information to calculate the beginning balance, but I promise you that it can be done with the information provided. Please pause the video to do your calculations and select your answer. Then start the video again to check your work. The correct answer is A, $90,000. As I'm sure you're aware, there are several pieces of information about the PBO that are missing. In addition to not knowing what the beginning balance is, we also do not know what the current year service cost is, and if there were any gains or losses or prior year service costs. But we do know that interest cost and the discount rate. Interest cost is always calculated as the beginning balance times the discount rate, so the beginning balance can be calculated as $7,200 interest cost divided by 8% discount rate. Thus, the beginning balance is $90,000 at January 1st. Well, that's all for this video. In the next video, we'll discuss pension plan assets. See you next time.